Welcome to today's whiteboard lesson on real estate investing. My name is Nick Foy, the founder of under30wealth.com and this YouTube channel. I upload videos every single day for you guys, giving away as much free knowledge as I can to help you get started investing and building wealth young in life. So this is, definitely a channel for you if you're into that money, personal finance, investing, trying to be entrepreneurial. Hit that subscribe button, hit the bell button to turn on notifications. Like I said, I upload a video every single day, so I don't want you to miss it. And today's video, we're going to be getting into a strategy called the BRRRR method, which is an acronym. It's BRRRR. So basically, what you start out doing, if I write out the acronym here, is you're buying a rental property. So you're going to make the purchase, then you're going to have to go in and renovate it. So you're going to buy it all cash, and the bank's not going to loan usually when they're in really rough shape. So you have to go in, renovate it. Then you could put a tenant in it, so rent it out. And then from there you can go to the bank and get refinance. So they'll put a mortgage on the property for you. You'll be able to pull out the money that you'd bought it with in all cash. And then you can repeat this process. So that's the acronym here. If we, kind of circle it. So it's called the BRRRR method, BRRRR, for buy, renovate, rent, refinance, repeat. Okay, so I want to just do some math examples to show you why this is an effective strategy that a lot of real estate investors use to build wealth over the long term. So to make math simple, we're going to target houses that are worth, we'll say that they're worth $200,000. So this is the after repair value, what's known as the ARV, after repair value. And we're going to say on average that we try buying these houses for $75,000 cash. So that's our purchase price, right? So that leaves us a potential spread of $125,000 to go towards, renovations, all the holding costs, property taxes, insurance. So after we subtract all that out, there's going to be some profit in the deal afterwards. And then we're going to go ahead and say that if it's a $200,000 house, there's what's known as the 1% rule or the 2% rule. This basically states that you try to rent out a property for 1% or 2% of the house's value as your monthly rent. So if we take a $200,000 house, multiply it by 1%, we're looking at rent of about $2,000 per month. So that would be how much we would charge for rent. And this rule of thumb between 1 to 2% is trying to safeguard you against all the rental expenses that you're going to face. So then if you subtract property taxes, insurance, maintenance and repairs, maybe some utility costs, after all those expenses, you want to still have some positive cash flow left over that goes into your pocket each week and into your bank account. So by setting the bar, at 1 to 2%, this should be enough rental income to cover all your expenses. But it's just a rule of thumb, so you can't rely on it. You still have to look around in your market and see, okay, what are typically these $200,000 houses renting for, and try to figure out what rents are locally. And that's really how you're going to determine how much you can rent for. You might be able to get more. In your market, you might be able to get $2,400. Or if you're in another market, you might only be able to get $1,800. All right, so now that we know we bought the house that's worth $200,000, we got it for, remember, $75,000, and we got it in cash. So this we said was the ARV. This is what we invested cash out of our pocket. So let's say that then we renovate it and we stick $30,000 of renovation cash into it. So again, this is money coming out of your pocket to renovate the whole place. And then let's say during the renovations, you've got property taxes and insurance. So let's say it took us 6 months to do, renovations. So if property taxes, we'll call this PT, let's say on the $200,000 house, those are $2,500 a year. And then insurance, we'll give it, $1,500 a year. So right there, you're looking at about $4,000 a year for both those. So 6 months, you paid about $2,000 towards all those expenses, property taxes and insurance. So we've covered our holding costs, we've covered our renovations, we covered the purchase price. So this is our all-in, how much profit we have before selling. So if we add all this together, that's $105,000 plus 2 is $107,000. So when we subtract $107,000 off $200,000, we've got about $93,000 in potential profit here on this deal. So now if we were to flip it, instead of holding it as a rental property, you're going to incur, real estate commissions, which are 6% typically. So that's $12,000 you're going to pay towards commissions. Then you might have another $3,000 you're going to pay in closing costs. So you're looking at maybe $15,000 coming off this for closing costs and real estate commissions. So that might leave you with $78,000 of profit. So when it's all said and done, this property is going to net you $78,000 in profit. And then next we're going to look at how much money we're going to earn each year on the rental side of it, holding on to it as a rental property. All right, so now we know that we've got built-in equity of about $78,000. So if we were to flip it, we could pull out that $78,000. That's how much we'd end up profiting after the sale. But instead, we're just going to refinance, put the property on a mortgage, and that's how we're going to get this money out so that we can use it to go buy our next investment property. So let's say, rental income for this $200,000 property, maybe it's $1,800 a month. And then, like we said, property taxes. So let's go ahead and do a calculator real quick to convert this to annual numbers. So $1,800 a month times 12. We're looking at about $21,600 a year in rent. So I'll put that off to the side here, $21,600. So back to property taxes, insurance. And then you're going to have maintenance and repairs. So this is all your expenses, to go fix if a window breaks or the stove stops working, or maybe you've got lawn care, you've got to pay someone to mow the lawns, to remove the snow, so all the maintenance expenses. And then you might have some utilities. So if you're paying the water bill on the property and your tenants, they're paying the gas and electric, you're still going to be responsible for paying some of the utilities. So the rest of them you're going to build into that rent you're charging. So property taxes on a $200,000 house, those might be $2,500 a year. Could be more, could be less. Every state is different. Insurance, earlier we said, is going to be about $1,500 a year. Again, this could vary. Maintenance and repairs, it's good to budget, maybe $500 a year towards that. It could be more, could be less, again, depending on what kind of services you're hiring to maintain the property. If you've got property manager, that could add on more money. But if you're managing it yourself, then you're probably just looking at, $500 should be pretty good, because you'll probably go over there and mow the lawns. You'll probably go over there and shovel the driveway. And then it's just a matter of, making minor fixes to things that might break, lights, appliances, things like that. So budgeting $500 a year is pretty reasonable. And then utilities is hard to estimate, but again, you could budget maybe $500 a year towards utility bills, depending on how you set up your lease. If you've got the tenant paying all utilities, even the water and sewage and trash pickup utilities, then you might not have this expense. But we're going to be real conservative here. So I wrote this out on the wrong side, but I'll go ahead and get a new screen in a moment. So adding all this together, we're looking at about $5,000 a year in expenses, because you've got $4,000 for property taxes and insurance, and then you've got another $1,000 to go towards maintenance, repairs, and utilities. All right, so reworking the numbers, if you're collecting, we said $21,600 a year, you're looking at maybe $5,000 a year in expenses on the property. Again, this might be low, it might be just right, it just depends. The numbers we're throwing out there are just made up random estimates. It could probably be higher than this, but going off these numbers just to show you how the math works, So you're gonna have about $16,600 of net income each year from this rental property, and then that's gonna go towards your mortgage, because remember, we're gonna refinance. So let's say that we get the place all fixed up. The bank comes out, they have an appraiser who values it at $200,000. So that's what we were estimating the ARV to be at. So let's say the appraisal confirms that, and the bank says, we'll loan up to 70% of the ARV, or the loan to value. The LTV is kind of the term that they give it. So if they value it at $200,000, they're going to only loan up to 70%. So they're going to offer you a loan at $140,000. So it's up to you if you want to max out as much of the loan as you can, or if you don't want as much leverage. So just going off, this $140,000, let's go ahead and head over to a mortgage calculator and see how much your monthly loan payments and annual loan payments would be on a $140,000 mortgage. All right, so here we are with the mortgage calculator. So I just typed it into Google. It brings up one here that's going to calculate everything for us. So let's say we do go ahead and max out and get that $140,000 mortgage on the property. That means the bank's going to give you $140,000 back so that you can take that check, put it in your bank account, and now you've got funds available to go buy the next property with. And then now you've got $60,000 of equity still in the property, and then you've got a $140,000 mortgage you got to start paying off. So that money is going to allow you to go buy the next property, and your rental income is going to start paying off that mortgage for you, so that you don't have to come out of pocket personally to pay down that mortgage. So let's say you're at a 4% interest rate over 30 years. You're going to look at $668 per month in mortgage payments. So if we pull up a calculator here, we'll go ahead and multiply $668 a month times 12, and that's going to get us $8,000 a year towards our mortgage. All right, so here's how much our net income would be after subtracting out the mortgage of $8,000. So we'd have about $8,600 in net income each year, and that's going to go in our pocket in the bank account. And once that starts accumulating, it's going to help add on to how quickly you can go buy those next properties. So now let's move on, showing you kind of how all the math works. So we've done a lot of different slides with different numbers. So this next slide, we're going to put it all together so that it kind of clicks and it all makes sense of how the cash and the money would be moving and the timing of everything. Okay, so starting off, we bought the property for $75,000. Remember, that's how much money we had to have out of pocket. So whether you have the money or you partner with an investor who's got the money, maybe you're an 18 or 19-year-old that's trying to get into real estate investing. You don't have that kind of money saved yet because you haven't started working a job. So you go to a family member or another investor that you're friends with that has that money. So they're the ones that put down the $75,000 to buy the house. Then they had another $30,000 they came out of pocket with to go towards all the renovations. And then during that time, you've got bills you're paying. You've got the property tax bill you had to pay online. You had to pay the insurance company. You had to pay utilities, lights, gas, water, sewer while you were renovating the place. So I think earlier we estimated that at $2,000. It might be more than that. But all in all, you had to have about $107,000 of cash to get the property all renovated before you could refinance and get your money back out of the deal. So then we went to the bank and they valued the property at $200,000, and they said, we'll give you a loan for $140,000. So now you put in $107,000 and the bank's giving you back $140,000. So $33,000 of that, is technically the equity in the property since it's worth $200,000. Remember that we said our all-in costs was about $107,000 plus we added on closing costs to sell and all that. But for the meantime, we have about $93,000 of equity in the property. So this $200,000 minus the $107,000 in expenses that we put into the property so far, that leaves us a profit of $93,000. But then remember, there's going to be about $15,000 in closing costs. So our true profit on this deal is going to be $78,000. So this was, our true profit. So we put 107 in, the bank gave us back 140. So that means that, we end up $33,000 extra. So we got our 107 back plus the bank gave us 33, which technically that's kind of coming out of your equity here because you had about 78 grand in equity in the property. So you're getting about 33 of that out now, and then the rest of it's kind of staying in. So later when you go to sell the property, you'll pay off that mortgage and you'll get the rest of that equity out. But in the meantime, you're pulling some of this equity out now along with your original money that you put into the property to fix it up. So you've got 140 grand now to go move on to the next property with. All right, so now your bank account is sitting at a nice 140 grand. So again, let's say we repeat the exact same process and you buy, a house for 75 grand. So obviously you're going to need then, let's say it's pretty much we'll use a cookie cutter example where it's just an exact replica. There's no two deals that are going to be exactly the same, but just to make, the numbers and the whole scenario make sense. Let's say this property again cost you the 30 grand to renovate it and you have the $2,000 again in holding costs. So again, you put out $107,000 on property number 2 coming out of your bank account. So now your bank account has got, that $33,000 still in it. Plus, remember, each year you're collecting $8,400 from property number 1, or $8,600 I think it was, but who cares? So that's the rental income you're getting from property number 1. Here's the profits that you still have in your bank account that are left after you spend all this money on property number 2. So your bank account's going to keep growing. So now you've got $41,000 in it. So once this starts accumulating enough, you're going to eventually be able to use all this money to go buy another property, and it's going to start snowballing. So right now you can only buy one property at a time because you only have, $140,000 in that bank account. But over time, as you keep accumulating more and more profits from each deal you're buying and rental income, it's going to keep snowballing, and you're going to start buying 2 deals. So then you're going to have, another replica deal here where you're buying a property, renovating it, paying holding costs. So here, let's say this is year 3, you're able to buy property number 3 and property number 4. So year 1, you bought one property. Year 2, you bought the second one. Now you've been able to accumulate enough profits off your first 2 deals that you went out and used it to buy deal 3 and then buy deal 4. So that's how you keep building up a portfolio, and it just starts escalating from there. You'll be able to start buying 2, 3, 4 deals in 1 year. And remember the math. So like if we've got, house number 1, we've got house number 2, and then we'll say house number 3. So each of these houses, we've got only $140,000 mortgage on it. So we're only levered, 70%. So there's still the 60 grand of equity in the property. Plus each year, that rental income is going to be paying down the mortgage. So you're going to build some additional equity every year from, paying down the mortgage from that rental income. So over time, your equity is going to grow and your percent leverage is going to go down. So eventually it's going to hit 60%, then it's going to hit 50%, and so on until that mortgage gets paid off. And you've got, $200,000 of equity in the property 15 or 30 years from now if you hold on to the rental that entire time. And then rental property number 2 is only leveraged at 70%. And, each time you buy these properties, we already showed you how the rental income covers the mortgage payment. So you don't have to worry, if you lose a tenant in one property, then you might still have to pay that mortgage. So eventually you're going to have enough net income coming in from your other properties to help support that property. So you've got net income from this property, net income from this property that can go into the bank account, and it's kind of is pooling up. So you're building up a stack of money in your bank account. So if this property ends up sitting vacant, you've got enough funds to still cover your mortgage payment for that house. So that's kind of the importance of not getting over leveraged, trying to stay at 70% or less, because if you over leverage, your mortgage payment's going to go up even more, and eventually if your properties are sitting vacant, it's going to be tough to cover that mortgage payment. But that goes back to where we said, our bank account, after doing the first deal, if we bought another deal exact same and spent the exact same amount of money, we'd still have about 33 grand chilling in that bank account. Plus, I told you how we'd be getting that $8,400 a year in rental income. That's net income after all expenses are paid off. So you're going to start pooling up money in your bank account that can go towards covering, the mortgage payments if one of your properties sits vacant. So it's always good to have cash on reserve here in case a property sits vacant and you have to cover the mortgage payment out of pocket. But ideally, you've got property 1, 2, and 3. So if property 1's producing net income of $8,400, property 2 is producing net income of $8,400, and I believe, what did we say our mortgage payment was? It's about $8,000 a year. So if this is producing no money because it's sitting vacant and you've got that $8,000 yearly mortgage, well, you don't have to worry about that because you've got 2 other properties that are bringing in $8,000 a year in net income that can help go towards that mortgage until you get this property rented back out. And then once it's rented back out, you'll start making, $8,000 a year from it, net income, because remember, these are doing about 16 grand, and then we're subtracting off the $8,000 mortgage, so that's what's leaving you with that $8,400 a year in net income. So that's what we call net income. All right, so to quickly recap, you're buying the property, so that's the B. Then you're renovating it, getting it ready to, lease. Once it's ready to go, you rent it out, you find a tenant. Once that tenant's in there paying you monthly rent, then you can go to the bank and get a mortgage because now you've got rental income coming in, and the bank's going to look at that and, they're going to be more willing to do a refinance. And you're kind of protecting yourself by doing this step first, so you get it rented out. Then when you go get the mortgage, you've got the income now to pay down the mortgage. If you did these steps in reverse, you understand what happens. You start paying a mortgage payment while the property sits vacant, so that doesn't make any sense. So rent it out first, then refinance, then repeat. So when we pull out that 140 grand from our first deal as an example, we can use that money to go find house number 2. So, depending on what you're targeting, what your criteria is, you could go find the next property might only cost $40,000. And then after renovating it and all that, you might only be in 60 grand. So that's going to still leave you with $80,000 we'll put up here. So now you can go get, property number 3. That might cost you $50K. You put $20K into it, $5K in holding costs. That's only $75K. So you still leave yourself $5 grand in the bank account to try to cover mortgage payments and whatnot if any of these properties go vacant. So now you just went and bought property 2 and property 3 off your money from property 1. And then you refinance those to pull out money on them, and you can keep snowballing, buying more and more properties by keep refinancing out the money that you're putting into them. So thanks for watching today's video on the BRRRR investment strategy. Good old acronym called BRRRR: buy, renovate, rent, refinance, repeat. I'll also link to an article on my blog that I wrote about this same strategy if you want to check it out. And there's also a real estate investing course if you're brand new and you want to learn how to buy your first property, how to raise some capital if you don't have much money, maybe you have a bad credit score, or you want to learn how to wholesale or flip instead of doing rentals. Either way, this course covers everything you need to know about real estate investing, so that's linked below in the video description. Go ahead and check it out, and give me your feedback on today's video if there's anything that I should explain clear on this strategy. So thanks for watching. Hit that subscribe button, and I will see you guys tomorrow with a new upload every single day.